Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, November 6th. Sell-off across major U.S. indices cooled yesterday, but uncertainties persist as the U.S. Supreme Court now questions the legality of Donald Trump's tariffs, and investors are waiting in the consequences of potential tariff rollbacks. So the U.S. yields are pushing higher, the U.S. dollar weakens across the board, while the Chinese technology stocks are doing well this morning in China on a fresh government ban targeting the usage of foreign chips in state-funded data centers. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So sell-off across major U.S. indices slowed yesterday and pressures eased if buyers came in to amass their favorite indices at slightly lower levels than the all-time high levels, while attention shifted toward rare economic data from the United States and nasty politics. So first, the Supreme Court in the United States hearing yesterday revived the discussions regarding the legality of Donald Trump's tariffs this year. So 3 out of the 6 members of the Supreme Court's GOP-appointed supermajority expressed yesterday skepticism regarding arguments backing Donald Trump's wide-ranging and jaw-dropping tariff raise against its major trading partners that was imposed a few months ago. And the 3 other judges in this 9-judge Supreme Court are Democrats, so who don't necessarily agree with these tariffs either. So yesterday's hearing at the Supreme Court suggested that Donald Trump's tariffs could simply be rolled back, and the probability of survival of these tariffs given by the prediction markets actually tumbled yesterday from the 40 to 50% range to around 25 to 30% range. Is it good news? Well, paradoxically, it is not great news for the market and investors because it means uncertainty, renewed volatility, and potentially more than 100 billion US dollar of refunds that the US government should make to other countries according to Bloomberg, and a deeper US deficit as a result of it. Bad, isn't it? Yes, it is. Also considering that the US debt now surpassed the 38 trillion US dollar mark and is decidedly advancing toward the $40 trillion psychological level with nothing really to stop this rise on the way, really. So that certainly explains a part of why the US 10, 20 and 30-year yields pushed higher at yesterday's trading session. Then, a better than expected ADP report also helped pushing the short-term maturity yields higher in the US as well. This week is the first week of a new month, so if the US government were open, we would normally be getting the latest jobs figures from the US, but because it is closed, well, there is no data available to investors and to markets except from private data providers. And in this context, well, the ADP yesterday released the latest jobs figures for the United States for last month, printing 42,000 new private job additions last month in the United States. So that is better than last month's 29,000 job losses, and it's better than the expectation of 32,000 job additions last month. But the number is still weak, mind you, and a series of lower than 50,000 new job additions would, in theory, point at recession. But alas, yesterday's weak, but still better than expected ADP print further weakened the Federal Reserve Dow's hands. As such, the US 2-year yield that best captures the Fed rate expectations jumped past the 3.60% level yesterday, and the probability of a December rate cut from the Fed further eased to 62.5%. So I'm a little surprised that the early week sell-off in the US didn't extend with a session really. This morning we see slightly improved appetite in Asia. The technology-heavy Hang Seng Index there returned above its 50-day moving average level as the local chip makers like SMIC jumped 5% in Asia today, and Alibaba rebounded 3% after the Chinese government banned state-funded data centers from using foreign chips. And also MSCI is now reshuffling its index to include more Chinese names into it. I think that we haven't seen over the past 2 years, and that's also certainly helping Chinese equity see better inflows from global investors today. And also earlier this week, remember, the People's Bank of China bought bonds to prop up market liquidity there. So the Chinese stocks remain in the race and provides, I think, an interesting diversification opportunity to US indices and US technology, as Jensen Huang says that China will win the AI race, but with the US. But you know who might not win the race? Tesla. Well, Tesla has been left behind as Chinese rival BYD in vehicle registrations in the UK and closed the sales gap in Germany as well. And wait, that's not it. In October this year, Tesla sold just 133 cars in Sweden. 133 cars. So when I say Tesla doesn't deserve this hype, and the PE ratio of 332 shows the gap between the stock price and the reality, I really mean it. Plus, there could be some more drama at Tesla if Elon Musk doesn't get his $1 trillion pay package approved by investors. And there are some reports out there that big investors reportedly are not willing to back that pay package. So let's see what else is there, but I wouldn't go that direction right now. Elsewhere, European car makers could also feel the pressure of renewed tensions over an Xperia on news that the company halted supply again as its Chinese unit refused to pay, while the US futures are flat this morning at the time I'm talking here. On one hand, yesterday's rebound in US yields and the worries regarding the big technology valuations are weighing on sentiment. But on the other hand, earnings keep coming in and they are looking strong. Qualcomm, for example, joined its peers with stronger than expected earnings and revenue and a solid forecast yesterday after the bell, but alas, its stock price slid 2.60% in the after hours trading. So the conclusion is the weather remains cloudy. Bulls remain hesitant, but still the buyers are just around the corner and waiting for great opportunities. I don't even know if there will be a reasonable dip from here when retail investors are so eager to jump back in and they are absolutely not willing to sell. I guess we will see. Now in the precious metals space, gold rebounded yesterday along with the US yields, meaning that gold is now behaving very, very unusually, and I put that weird behavior on the back of the latest meme-like rally in gold prices that probably temporarily deactivated gold's safe haven status. I believe that we should then see a deeper pullback here and some period of consolidation for the yellow metal around the $3,800 level or below to reclaim the status again. But the longer term outlook for gold doesn't change. It is positive. And if you feel like you're not sure about it, well, just look at the developed markets, debt levels, and I'm sure you will be a little bit more optimistic regarding the gold's shiny future. In the traditional currencies, the US dollar's latest rally hit a speed bump into the 200-day moving average yesterday, and the greenback is broadly sold against most majors this morning. In this context, the euro-dollar is back above the 115 psychological level, and more importantly, the pair successfully defended a minor Fibonacci support yesterday that could eventually improve appetite in the euro in the short run, but solid resistance is still seen into the 115.80, 116 level to reverse the latest bearish trend. And across the channel, cable managed to hold ground at the 130 psychological mark amid the latest severe sell-off. The Bank of England will probably maintain its rates unchanged at today's monetary policy announcement, and I believe that even the Bank of England dolls are somehow convinced that the bank must wait before hearing the crunchy details of the upcoming autumn budget that will be announced by the end of this month. Funnily, Rachel Reeves actually gave a small spoiler on Tuesday this week about how that budget might look like. if nothing, to see the market's reaction to what she will be putting out there by the end of this month. And the probable tax hikes actually boded quite well among investors, and the 10-year gilt yield remained mostly contained. So that means that the Bank of England might jump in and take some pressure off in the coming months by cutting the interest rates, but not in this meeting, probably in meeting following this week's. And that is still bearish for sterling in the medium run. So voila, let's see what the Bank of England has to say, but this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
This content is intended for individuals who are familiar with financial markets and instruments and is for information purposes only. The presented idea, including market commentary, market data, and observations, is not a work product of any research department of Swissquote or its affiliates. This material is intended to highlight market action and does not constitute investment, legal, or tax advice. If you are a retail investor or lack experience in trading complex financial products, it is advisable to seek professional advice from a licensed advisor before making any financial decisions. This content is not intended to manipulate the market or encourage any specific financial behavior. Swissquote makes no representation or warranty as to the quality, completeness, accuracy, comprehensiveness, or non-infringement of such content. The views expressed are those of the consultant and are provided for educational purposes only. Any information provided relating to a product or market should not be construed as recommending an investment strategy or transaction. Past performance is not a guarantee of future results. Swissquote and its employees and representative shall in no event be held liable for any damages or losses arising directly or indirectly from decisions made on the basis of this content. The use of any third-party brands or trademarks is for information only and does not imply endorsement by Swissquote, or that the trademark owner has authorized Swissquote to promote its products or services. Swissquote is the marketing brand for the activities of Swissquote Bank Limited, regulated by FINMA, Swissquote Capital Markets Limited, regulated by SISEC, Swissquote Bank Europe SA, regulated by the CSSF, Swissquote Limited, regulated by the FCA, Swissquote Financial Services Limited, regulated by the Malta Financial Services Authority, Swissquote MEA Limited, regulated by the Dubai Financial Services Authority, Swissquote PTE Limited, regulated by the Monetary Authority of Singapore, Swissquote Asia Limited, licensed by the Hong Kong Securities and Futures Commission, and Swissquote South Africa Limited, supervised by the FSCA. Products and services of Swissquote are only intended for those permitted to receive them under local law. All investments carry a degree of risk. The risk of loss in trading or holding financial instruments can be substantial. The value of financial instruments, including but not limited to stocks, bonds, cryptocurrencies, and other assets, can fluctuate both upwards and downwards. There is a significant risk of financial loss when buying, selling, holding, staking, or investing in these instruments. Swissquote makes no recommendations regarding any specific investment, transaction, or the use of any particular investment strategy. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. The vast majority of retail client accounts suffer capital losses when trading in CFDs. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Digital assets are unregulated in most countries and consumer protection rules may not apply. As highly volatile speculative investments, digital assets are not suitable for investors without a high risk tolerance. Make sure you understand each digital asset before you trade. Cryptocurrencies are not considered legal tender in some jurisdictions and are subject to regulatory uncertainties. The use of internet-based systems can involve high risks, including but not limited to fraud, cyber attacks, network and communication failures, as well as identity theft and phishing attacks related to crypto assets.